In terms of direction, yesterday and today, we've been kind of all over the map. We saw steep declines last week. It was a pretty steady drop down. But this week, on Monday, the S&P 500 rose as much as 3.4%. Yesterday, as much as 4.1%. Today, it was up as much as 1.4%. Could you read that as a sign that the selling is exhausting itself?
I think temporarily, yes. But there's still going to be another down leg. If you look at, say, the poly market contract about whether Trump will significantly reduce the tariffs that were implemented last night, I think like 66%, like 2/3 of bettors on that site expect that he will. That might be too optimistic. And perhaps even more importantly, the economy is turning down. I think a recession at this point is almost inevitable. And if you look at the forward P ratio for the S&P 18, it's not at recessionary levels. Credit spreads are not at recessionary levels. Even commodity prices are not at recessionary levels. So the market hasn't fully priced in a recession yet.
Okay, when you say a recession is all but inevitable, initially your odds of recession were at 75%. That was at the start of this year. It was actually after the election. When you say inevitable, are we talking about 90%, 100%?
It's never going to be 100%, but probably in the range of around 90% at this point, yeah.
Okay. You are an economist by training. We should add that as well. You were at Goldman Sachs, and before that, you were at the International Monetary Fund. We know companies have been front-running the tariffs. They were ordering a lot of stuff in advance of the tariffs being implemented. We know that consumers are currently in a big rush to buy as many things as they can before prices go up. That being the case, how reliable will the economic data be in the coming weeks?
Well, we're not going to get a lot of data over the next few weeks. The trickle of data that we've gotten so far does look worrisome. So one data set that I look at are job openings from Indeed, as well as from LinkUp. LinkUp is this analytics firm that tabulates job openings on a daily basis from the 10,000 largest U.S. employers. That series has seen a fairly sharp decline just over the last week or so. So it does look as though the labor market is breaking. And I would imagine that as we get data over the course of this month, we're going to realize that most likely the recession started in April.
Right. Because the data tends to be backwards looking, and it just feels like the data that we're going to be getting is going to be pretty messy and not necessarily accurately capture all the changes that are taking place. There is just a snapshot of a moment in time.
That's right. And we haven't really seen the impact of the trade war yet, because as you correctly pointed out, what was happening up until recently was that there was a lot of tariff front running. People were buying things to get ahead of those tariffs. But now that tariffs have gone up, we're going to have the opposite effect. We're going to have tariff front waiting. People are going to be waiting for the tariffs to come down, at least waiting in hope that they'll come down. And that means they're not going to be doing much in the way of buying. So we could see this step down in economic activity, which will probably appear in the data later this month and into May.
Yeah, and it'll probably look pretty dramatic as well. So, I mean, nobody knows what President Trump is going to do, but given that so many of his supporters, at least on Wall Street, are urging him to perhaps ease up on the tariffs, if he were to back down, could we avoid recession? Is that even a possibility, or have we gone too far?
I think it'll be hard at this point. I mean, I think Trump has sort of dug in his heels. He almost has kind of this critical trade theory version of trade, that any trade deficit with the U.S. by any country must be the result of discrimination by that country against the U.S. He seems very, very wedded to that view. So I think the only way we could get a reversal in these policies is that Congress takes action, but right now I don't get the feeling that there's enough movement within Congress to strip away his authority over tariffs. That'll probably come, but most likely it'll only come once the economy is in a full-blown recession.
Okay, so in other words, too late. As you're speaking, we're looking at the 10-year yield spike up by 15 basis points. The 30-year yield, as I mentioned earlier, did reach 5%. We've moved on to this new phase in the market dynamics, to a bonds-driven story. How does this spike in yields affect stocks?
Well, it's bad news because usually when the economy weakens, bond yields go down, and that provides a soothing force that helps to mitigate the economic downturn. We're not getting that this time around, partly because tariffs are going to push up inflation, and that makes it more difficult for the Fed to cut rates, but also because I think increasingly foreigners are asking themselves whether they want to hold all that many treasuries, but 1/3 of US treasuries are held by foreigners. We also, I think, have the reality that the fiscal situation is very, very dire. People are worried about that. And now, of course, we've got the unwinding of the basis trade, which is only adding to the upward pressure on bond yields.
Okay, so for a variety of reasons, bonds are not where people necessarily want to be. So if treasuries are not a safe place to hide or no longer as safe a place to hide, what is your recommended haven?
I think you want to be in cash. You want to be in gold. You want to own safe haven currencies, not the US dollar, unfortunately, anymore, but maybe the Swiss franc, the Japanese yen. If you do have to be in stocks, then favor more defensive sectors such as consumer staples and healthcare over, say, consumer discretionary, tech, or industrials.